Basel III Endgame. Why it matters to you. Global banking rules are changing. You may not work in finance, but if you borrow money, invest, use derivatives, or work at a bank, these changes will affect the cost and availability of financial services you rely on. Here is what is actually happening and why it matters. 1. Regulators want banks to set aside more money as a cushion against losses. That sounds safe, and it is. But capital sitting on a shelf is capital not being deployed through loans, mortgages, or lines of credit. When the cost of holding capital rises, the cost of borrowing tends to rise with it. 2. The US, Europe, and the UK are each implementing their own version of the same framework on different timelines with different calibrations. For businesses and investors operating across borders, this creates real complexity. Products priced in one market may not work the same way in another. The rules are fragmenting, and that fragmentation has a cost. 3. New rules for how banks calculate risk in their trading books mean that market making, hedging, and structured finance all carry higher capital charges. Banks pass those costs on. If you hedge currency risk, use interest rate swaps, or issue bonds through a bank, those costs are moving. 4. The US re-proposal is open for public comment until June 18. After that, the rules move toward finalization. For anyone with a stake in how capital markets function, that is the window to engage. Most people will not. The institutions that do will have more influence over the final framework. Basel III is not abstract regulatory plumbing. It is the architecture that determines how much credit flows into the economy, at what cost, and on whose terms. Follow Flat 98 if you want to stay informed.